Hello, and welcome to a demo video that will help you with your Chapter 8 homework. So what I'm going to do is I'm going to work on problem 8.1b. So the B problems are posted in Blackboard, and this video will coincide with that problem 8.1b. Okay. As we go through this should really help you with your homework, which is textbook problem 8.1a. Okay. All right. So what we have here is, well, it's an inventory problem, really, right? So if we notice here, we have various inventory issues. And there are 5 independent situations that are related to accounting for inventory. So we're going to look at each of these individually, go through them, show you how to calculate them, and hopefully that'll help you out with your homework. If you have completed your homework and turned it in, watch the video, obviously. And if you catch any errors, you can go back, change it, and resubmit. Okay, so the first one looks at Hammer Company. And Hammer Company purchased goods with a list price of $260,000, subject to trade discounts of 25% and 10%, with no cash discounts allowable. How much would Hammer Company record as the cost of these goods? Okay, so what we're looking at here is we're really looking at a company purchases inventory, but the list price that they charge is $260. Okay, that trade discount is 25, can either be 25% or discounts of 25% and 10% with no cash discounts allowable. So basically what happens is a company creates catalogs, right? And this catalog has all their products in it, and it also has the catalog price. Now, to prevent companies from having to constantly update the prices in these catalogs, they offer trade discounts. Okay, so what a trade discounts is a discount from the catalog price or from the list price. Okay, so how it works normally is a company might list out a product and say it's going to be $100 for this product. However, they may offer a trade discount, which means that here's what it's listed at, but I'm not going to sell it to you for this. I'm going to sell it to you less than this. So here's what we need to do. We need to recognize first that the price on these or within these catalogs or these list price is $260,000. Maybe. Okay. Now, they get a 25% discount on that list price. Okay. So what we're going to do then, bear with me here, and we're going to say this is the list price. Okay. What we're going to do then is we're going to calculate that discount, right? Or that specifically that trade discount. So to calculate the trade discount, I'm going to take the list price, $260,000, and I'm going to multiply that by 0.25. I end up with, bear with me, $65,000. Okay, this is my trade discount, right? So when we see this, then how much exactly does this customer pay? Well, we're going to take our list price and we're going to subtract out our trade discount. So we get $195,000, okay? We're not done yet because it looks like, based on the problem, they are subject to two trade discounts, 95 or 25% discount and a 10% discount. Okay, so we're going to plug in our $195,000. Okay, now we're going to take into account that additional 10% discount. Okay, so to figure that out, we do the same exact thing, right? We take our $195,000 cost of this inventory that we're buying, and we're multiplying it by 10%. We end up with 19.5. So now, if we subtract the cost of 195,000 minus another trade discount, we get $175,500. This right here is the cost of goods purchased. Okay, so basically what we're doing, what companies do, and again, they put out for lack of a better term, a catalog. Here's all the products that we offer, and here's how much we're going to charge you for them. Okay, so in this example, a merchandiser looked through the catalog and said, okay, I want to order all this merchandise so I can turn around and resell it. The list price was $260,000, but the company that's selling, or we'll say the wholesaler, says, you know what, that $160,000 list price, I want to give a discount, right? I don't want my customers to have to pay $260,000 for all this merchandise. And instead of, again, to reiterate, constantly updating our price list, we just offer trade discounts from the list price. That's all it is. Okay, so that is number one. Now let's look at number two. Okay, go right here, number two. Okay, so number two says Pine Company's inventory of $1,761,000 at December 31st, 2020 was based on a physical count of goods priced at cost and before any year-end adjustments related to the following items. So item A said goods shipped from the vendor, FOB shipping point, on December 28th, 2020 at an invoice cost of $85,500 to Pine Company were received on January 2nd, 2021. Okay. Part B says the physical count included $61,000 of goods billed to Douglas Corp. FOB shipping point on December 31st, 2020. The carrier picked up these goods on January 1st, 2021. Okay. They want to know what amount should Pine report as inventory on its balance sheet. So let's look at A first. Okay, let's do 2.A. That's what I'm going to call it. So we have inventory of, and bear with me here for 1 second. Okay, we have inventory valued at $1,761,000. Okay, and this is as of 12/31/2020. Why did you do that? Sorry about that. It was a short date. There we go. Okay, 12/31/20. All right. So A says that goods shipped from a vendor, FOB shipping point. Okay, so right off the bat, we need to identify who are we in this transaction? Are we buying or are we selling? Well, it says goods shipped from a vendor, FOB shipping point, on December 28, 2020 at an invoice cost of $85,500 to Pine Company. We are Pine Company in this example, okay? So since it's FOB shipping point, when do we take ownership? Well, since it's FOB shipping point, we take ownership as soon as the transporter accepts those goods, right? So the shipping company picked up these goods on December 28th, and they delivered them to us on January 2nd. Because it's FOB shipping point, we take ownership as soon as the carrier accepts those goods and brings them to us. So in this example, we need to add the $85,500. And our value of our inventory now should be $1,846,500. Again, to reiterate, the $85,500 of goods in transit on which the title passed on January 28th, because it's FOB shipping point, should be added to the inventory on 12/31/2020. Okay? Now, let's look at B. 2B. 2B says that we have $61,000 of goods billed to Douglas Corp. FOB shipping point on December 31st, 2020. Carrier picked these goods up on January 1st, 2021. Okay, so let's think about it this way, right? It's FOB shipping point. Okay, that means that the seller, or I'm sorry, that means that the buyer takes legal possession when shipped. Okay, the problem tells us that these goods were picked up on 1/1/2021. Oh, darn it. Okay, so that means that $61,500 of goods, excuse me, excuse me. Okay, that 61,000 of goods shipped FOB shipping point on January 1st, 21. Those should remain as part of Pine's inventory at on December 31st, 2020. So for part B, we're just going to say, hey, they should remain these $61,000 worth of inventory. Shipped FOB shipping point on January 1, 2021 should remain should remain in Pine's inventory. Okay, so that's 2B. Now let's look at 3, right? 3 says Potter Corp had 1,000 units of part Z65 on hand July 1st, 2020, costing $62 each. Purchases of Z65 during July were as follows. So we had, and we're just going to plug this in right here. Okay, so we're going to remember, anytime you got to calculate inventory costs, you always got to start off with your list of what was purchased, how many units were purchased, when they were purchased, and at what cost. So on July 1, good Lord, I apologize, guys. Okay, so we'll say on 7/1/2020, we had on hand 1,000 units at a cost of $62 each. Okay, these are going to be my units. It's going to be the cost, and here's going to be the total. Okay, so they tell us then on July 3rd, we bought 3,000. They had a cost of $63. On July 16th, we bought 2,000 units at $65. And on July 27th, we bought 1,000 units at $66. Okay? So, and this is that product Z65. So, a physical count on July 31st, 2020 shows units of $1,500 as units of part Z65 on hand. Using FIFO method, what is the cost of part Z65 inventory at July 31st, 2020? Using LIFO inventory, what's the inventory cost? Using average cost method, what's the inventory cost? So for number 3, we need to recognize that because no dates are associated with units issued or sold, the periodic inventory method should be assumed. So right off the bat, we need to assume periodic. Why? Well, we need to assume periodic because there's no dates, there's nothing associated with units sold, right? Meaning the date that we sold those, okay? Or the number of units. So let's look at FIFO, first in, first out, right? So we already know that we have our ending inventory is 1,500 units. So that's what we need to find, okay? So what we're going to do is calculate our inventory costs, right? So if we have on hand $1,500, we need to use FIFO first. So what does FIFO mean? FIFO means first in, first out, all right? So that means that the costs that came in first, and I'm going to highlight these. Actually, I'm just going to highlight the first two, okay? Since it's FIFO, our oldest costs or first costs are going to be recognized as cost of goods sold, okay? Our newer costs or the most recent costs are going to be part of our ending inventory. So first thing I'm going to do is I'm going to look at the lot, this lot right here, which is 727.20. That remains in ending inventory under FIFO. So I'm going to put in my 1,000 units. At $66, which gives me 66,000. Then I still have 500 more units to go, right? Because my on hand or my ending inventory is that 1,500 units, okay? So I'm going to take 500 units at $65 and I get 32.5. So under FIFO, my inventory costs or my ending inventory is going to be $98,500. Okay. Now let's look at LIFO. So what does LIFO mean? LIFO means last in, first out, right? So with LIFO, I'm gonna come down here and say with LIFO, the the newest costs, or last cost, is recognized as cost of goods sold. Okay, so all these costs down here, right, starting from the bottom, or starting from the newest cost, which would be 727, these costs end up being part of our cost of goods sold. Okay, the oldest cost, and I'm going to make this green. Okay, so these costs end up as our cost of goods sold. These older costs end up remaining in ending inventory. So I'm going to start with 1,000 units at $62. And I need 500 more units, so I'm going to take 500 units from the July 3rd lot, 3,000 units at $63. Well, I only need 500 of those. So I'm going to take 500 at 63. Don't know why that looks like that. Should not look like that. What in the world? I apologize. There we go. All right. So 500 times 63 gives me 31.5. That means that my ending inventory under LIFO equals 93,500. This is my ending inventory, okay? Now, the next thing they want us to do is our average cost. Well, this is really easy, right? So here's what we're going to do. I'm going to come back up to my chart here, and I'm going to say equals, and I'm going to calculate the total cost for each lot, okay? So that means that my total costs now are going to be $447,000 of inventory. Okay, how many units do I have of this piece? Well, I got 7,000. So to figure out what the average cost is, I'm going to take my total cost of 447,000, and I'm going to divide that by my 7,000 units. So when I run those numbers, I see that I get $64. I'm going to take it out 2 decimal places, 63.86. So I need to figure out what my ending inventory is. Well, I know that I have 1,500 units in ending inventory. I know my average cost is $63.86. When I multiply these out, I see that my ending inventory is 95,000. $95,786. There we go. 957. Wait a minute. In the world, 1,500 units times $63.86. $95,790. Had something kooky going on there with Excel. But that's our answer for ending inventory under average cost. Okay, so let's look at 4. What's 4 say? 4 says Hirsch Company adopted the dollar value LIFO method on January 1st, 2020. Using internal price index and multiple pools, the following data are available for inventory pool A for 2 years following the adoption of LIFO. Okay, so what we need to do is compute an internal index and use the dollar value LIFO method and we should, or we need to compute that and answer at what point or at what amount should inventory be reported at on July 31st, 2020. Okay, so the first thing that we're going to show is we're going to compute our price indexes. Okay, so the first thing I want to do, this is going to be number 4. First thing I want to do is figure out what is, or first of all, I want to figure out at what time period am I using, right? So the first, what they ask for is what should the inventory be reported at on December 31st, 2020. So on 12/31/2020, okay, I need to report, I need to know what is my current year's cost, and I also need to know what the base year cost is, okay? So to figure out what my price index is, oh, sorry. At 12/31/20, I need to first take the I need to take my current year cost, and I need to divide that. I need to divide that by my base year cost. Okay, so excuse me. Looking at December 31st, 2020, I see that my cost at that year is $375,440. As of that year, my base cost is 361 or 361,000. When I divide these two, I end up with 1.04, right? But I need to multiply this by 100. So bear with me here. Okay. There we go. Okay, so then I multiply this by 100. I end up with 104. So that's my price index in year 2020. I have to do the same thing for year 12/31/21. Okay, so I'm going to apply the same calculation here, right? I know that my my current year cost as of 12/31/2021 is $449,080, and I know that my base year cost as of 12/31/2021 is $412,000. Okay, so I'm going to apply this equation to these numbers to figure out what my price index is. Super easy. I take my 44980, divide it by my 412,000, multiply it by 100, and I get 109. So those are my price indexes, okay? So the next thing I need to do is I need to look at the dollar value LIFO inventory for 2021. Super easy for us to do. So to figure out the dollar value LIFO, what I need to do is first look at, and again, this is as of 12/31/20. So I need to first figure out how much did my inventory increase by, right? Looking at LIFO. Well, that's easy to figure out. I already know what my costs are, right? So I'm going to take my $361,000 and I'm going to subtract $334,000. Let's do it anyways. Okay, that's not right. What did I do wrong? Okay, here's what we're doing. We're trying to figure out the increase of the base year cost between 1/1/20 and 12/31/20. Okay, so to figure that out, I need to take my $361,000 and subtract my $334,000. That should equal $27,000. Okay, now what I need to do then is I need to take into it, or bear with me, that's my increase. Okay, so now what I need to do is multiply my 12/31/20 index or price index, which I already calculated over here is being 104. Oh. Okay, or 1.04. When I multiply these together, I get a there we go. I get 2080. This is my 2020 layer. Okay. Then what I need to do is I need to take into account, or before I do that, this is my increase in terms of 104. Okay. So now what I need to do is I need to take my base inventory, which I already know my base inventory is $334,000. I'm going to add these two together. And I get $302,080. This right here is my dollar value LIFO inventory. Okay? Now, for number 5. Number 5 is actually pretty easy for us, right? So they tell us that White Incorporated, a mega retail store, had the following information in the general ledger for year 2020. We have merchandise purchased for resale, $2,684,100. Interest on notes payable to vendors. Purchase returns, freight in, freight out, and cash discounts on purchase. So what we need to do is figure out what are our inventoriable costs. Super easy, right? So for inventoriable cost, we start off with the merchandise purchased, right? Which we know to be $2,684,100. Next, we need to add freight in. Well, the freight in was $56,100. So if I add these two up, I get $2,740,200. Okay. Now I need to deduct my returns or my purchase returns, which the problem tells us are 121,600. And I also need to deduct my purchase discounts, okay, which are 24,850. And bear with me for 1 second. Okay. So if I subtotal up all these deductions, which are my returns, purchase returns, and purchase discounts, I get 146,000. So to figure out what our inventoriable costs are, I take my $2,740,200 and I subtract my discounts and allowances. I end up with $2,593,750. Okay, so that's how we do the dollar value LIFO, which is first calculating what our price index is, and then calculating what the increase was of our base year, multiplying the price index by that, getting my increase in terms of, in this case, the price index of 104. I take my base inventory and I add that increase in terms of 104, and I get my dollar value LIFO inventory. Okay, so hopefully that should help you out with your homework. If it does not, let me know. Shoot me a text, say, hey, I'm still lost. Can you help me out? I would be happy to. Okay, so thanks for tuning in, and we'll see you tomorrow.